It's time to explore simple moving averages. Ready to take your chart reading skills to the next level? This lesson breaks down how simple moving averages are calculated, how they help identify trends, and when to trust them or take them with caution. You already know that moving averages help smooth out price data. Unlike other types of moving averages, a simple moving average, SMA, gives equal weight to each closing price in the period, creating a steady line that shows the market's overall direction. To calculate an SMA, you add up the closing prices, A, over a specific number of periods, then divide that total by the number of periods. Now that you understand how SMA is calculated, here's the next question. What if you used 10 or even 50 periods instead? The number of periods you choose directly affects how the SMA behaves. Shorter period SMAs, like 5 or 10, follow price closely. They, 1, react quickly and can help spot short-term reversals, but they may also generate false signals during volatility. Longer period SMAs, like 50 or 200, respond more slowly. They, too, smooth out noise and help confirm stronger, more stable trends, but they might delay entry or exit points. The length of the indicator you use should match how you trade. If you're a short-term trader, like a day trader or scalper, you'll need to react quickly. Shorter SMAs respond faster to price changes and help you spot quick shifts in direction. If you're a long-term trader, like a swing or position trader, you're more interested in spotting the overall trend. Longer SMAs help smooth out short-term noise and reveal the bigger picture. Remember that there's no best setting, just the best one for your strategy. Time for a quick quiz. Alex is a day trader who enters and exits trades within minutes or hours. He needs to react fast to small price movements and identify quick trend changes. Which simple moving average period is most suitable for Alex's trading style? 10, 50, 100, 200? Yes, you're right. Exactly. A 10-period SMA gives Alex fast feedback which suits his day trading strategy. Time for a quick quiz. Jane is a swing trader who holds positions for several days or weeks. She wants to filter out market noise and follow the broader trend. Which SMA period is most suitable for Jane's strategy? 100, 5, 10, 20. No, the correct answer was 100. Nope, shorter SMAs may give faster signals, but they also add noise, something swing traders like Jane try to avoid. Choosing the right period is just step 1. SMAs work best in clear trending markets where price moves steadily up or down. In these conditions, they help confirm direction and support confident trading decisions. But in sideways or choppy markets, the SMAs tend to flatten out. This can lead to false signals that trigger early entries or exits. That's why context is key. Before acting on a SMA signal, always assess whether the market is trending or just moving sideways. SMAs can also act as dynamic support or resistance. If price bounces off an SMA from above, the line acts as support. 1. If the price is below and struggles to break through, it acts as resistance. 2. Signals are stronger when the SMA aligns with other key levels like support, resistance, or trend lines, creating confluence that boosts trader confidence. Knowledge check. What does the simple moving average tell you? Match the simple moving average behavior to the action it might suggest. Each clue helps you decide whether to enter, stay, or wait. Well done! You've just completed one of the core concepts in technical analysis, the simple moving average. You've learned how to calculate it, when to apply it, and how it helps spot trends. Up next, the exponential moving average, a more reactive tool that helps you catch market moves earlier. Let's keep going. It's time you already know to calculate an S. Now that you understand longer period S, the length of the indicator. If you're a time for a quick quiz. Alex is a day trader who enters an egg. Yes, you're right. Exactly. Time for a quick quiz. Jane. Yes, you're right. Correct. SMA helps Jane choosing the right period, but in sideways or choppy markets, the SMAs tend to flatten out. This SMAs can also signals are stronger. Knowledge check. What does the simple moving average tell you? Match the simple moving average behavior to the action it might suggest. Each clue helps you decide whether to enter, stay, or wait. Great job. In short, SMAs smooth price action, highlight trends, and act as dynamic support or resistance, but they lag behind price and can give false signals in choppy or sideways conditions. For best results, use them with confirmation from other tools. Well done! You've just completed one of the core concepts in technical analysis, the simple moving average. You've learned how to calculate it, when to apply it, and how it helps spot trends. Up next, the exponential moving average, a more reactive tool that helps you catch market moves earlier. Let's keep going. Let's explore exponential moving averages. Now that you've got a solid grip on simple moving averages, it's time to level up. In this lesson, we'll dive into the exponential moving average. You'll learn how it's calculated, how it compares to an SMA, and how to use it to spot both short-term and long-term trends. The exponential moving average, EMA, 1, is a moving average that puts more weight on recent price data. It reacts quicker to price changes than simple moving average, 2, making it useful for short-term trading or fast-moving markets. EMA is designed to respond faster to recent price changes than a SMA. Instead of averaging all prices equally, the EMA applies a weighting multiplier to give more influence to the most recent price and less to older prices. Looks complicated? Don't worry about the math. Your platform will calculate it. However, understanding how EMA gives more importance to recent prices will help you trust its signals. Now let's see how it stacks up against the SMA. They both smooth out the price. However, the EMA, 1, is quicker to react to recent moves, while the SMA, 2, stays calm and steady. EMA is more responsive. Because it gives priority to the latest price data, it adjusts quickly when the price changes direction. This makes it useful in fast-moving markets, where early entry or exit matters. But this speed comes at a cost. It may give false signals during sideways or volatile markets. Let's say a stock suddenly jumps. The EMA will rise quickly to reflect that move, helping you jump in sooner. But if that spike is short-lived, it might overreact and lead you into a losing trade. The SMA moves slowly because it treats all prices equally. This makes it more stable and less likely to be fooled by short-term volatility. It is useful when you prefer confirmation over speed. For example, imagine a market that keeps the SMA moves slowly because it treats all prices equally. This makes it more stable and less likely to be fooled by short-term volatility. It is useful when you prefer confirmation over speed. For example, when you're following longer-term trends or avoiding whipsaws in noisy markets. Imagine a market that keeps bouncing up and down. The EMA might react to every small move, while the SMA stays more stable, helping you ignore the noise and focus on the bigger trend. Now that you understand how both the simple and exponential moving averages work, you might be wondering, which one is better for your strategy? The answer depends on how you trade. Traders use the exponential moving average when they need faster signals, perfect for short-term trading where speed matters more than precision. Meanwhile, traders choose the simple moving average when they're focused on longer-term trends, prefer smoother signals, and can afford to wait for confirmation. Knowledge check. Spot exponential moving average. Test your knowledge. Pick the 3 facts that best describe exponential moving average. Knowledge check. And what does the exponential moving average period tell us? Different EMA periods reveal different insights. Can you match each EMA length to what it typically helps a trader understand? You've now mastered the exponential moving average, how it works, why it reacts faster, and when to use it. Next, we'll explore crossover strategies to help you time your trades more effectively. Let's go. It's time to explore crossover strategies. Now that you know how simple and exponential moving averages work, it's time to combine them. In this lesson, we'll explore crossover strategies, powerful tools for spotting trend shifts and confirmations. Let's get started. Using a single MA can give you a general sense of direction, but what if you want more detail? That's where combining two MAs comes in. By comparing a short-term average, 1, with a long-term one, 2, traders get a clearer picture of momentum shifts and possible trend changes. When the short SMA crosses above the long one, it's often called a golden cross, reference 1, a bullish signal suggesting a strong upward trend may follow. When the short SMA crosses below the long SMA, it's known as a death cross, reference 2, a bearish signal that could indicate a downtrend. In an uptrend, a golden cross signals rising momentum. Traders often use this to enter long trades, add to existing positions, hold through small pullbacks, trusting the trend. In downtrends, a death cross warns of weakness. Traders use it to close or reduce long positions, enter short trades, avoid buying dips until the trend changes. But remember, these signals work best in trending markets, not sideways ones. Golden and death cross signals can be used with both simple and exponential moving averages. The classic setup uses SMA 50 and SMA 200, but many traders prefer using EMA 9 and EMA 21 for faster short-term signals. It all depends on your trading style. SMA gives smoother, long-term confirmation, while EMA reacts quicker for earlier entries. Time for a quick quiz. You're analyzing a stock using the 50-period and 200-period simple moving averages. The 50 SMA just crossed above the 200 SMA after a long downtrend. How would you respond to this potential golden cross setup? Do nothing. It's just noise. Enter a long trade, buy. Short the stock, sell. Wait for price confirmation. No, the correct answer was enter a long trade, buy. Not quite. While it's smart to be cautious, this signal and price breakout often indicate strength, not a trap. Now you know what a crossover is, but did you know you can also combine different types of MAs to enhance your strategy? Using both the EMA and SMA together can help you balance speed and stability, giving you sharper signals and stronger confirmation in any market condition. As you know, SMA helps confirm the bigger picture while EMA gives you faster signals. When used together, they balance each other out, helping you stay in trades longer while still reacting to momentum shifts. The periods you choose affect how your EMA and SMA behave. Let me introduce you to a strategy that does just that. The multi-period moving average crossover momentum strategy. It helps you spot when short-term momentum breaks through longer-term trends so you can ride big moves with confidence. This strategy combines a 9-period EMA, reference 1, a 30-period SMA, reference 2, and a 50-period SMA, reference 3. The 9 EMA responds quickly to price, while the 30 and 50 SMAs show the broader market trend. You're looking for crossovers between the 9 EMA and the slower SMAs. When the 9 EMA crosses over or under the 30 and 50 SMAs, it gives clues about momentum and direction. When the 9 EMA crosses above both the 30 and 50 SMAs, it shows strong upward momentum. This is often a signal to enter a long trade, add to an existing position. When the 9 EMA crosses below both the 30 and 50 SMAs, it may suggest the start of a downtrend. Traders may enter a short trade, exit or reduce long positions, tighten stop losses. If the 9 EMA keeps crossing above and below the 30 and 50 SMAs, the market might lack direction. In this case, it's often better to stay out of trades, wait for a clearer